Yes, good morning again to all attendees and of course panelists. Great you're here in another Treasury Excel webinar session. Today it's about technology and ethics, and it remains very relevant. The markets are volatile. There's an anti-globalization talk going on, but I don't think ethics pairs will ever stop being there. So we cannot turn back the time back. So let's talk about FX fluctuations, their impact on your P&L, and listen to experts. And I think they will share one or two things that you can use as a treasurer or CFO or group controller in your daily operations. My name is Pieter de Kiewit. I will moderate, and we have three great panelists. First, Jesper, with this nice Lunar background. I'm not sure if that's a conscious choice. He has worked on the corporate side as well as in banking. Now, currently, we have a challenger bank. He knows about markets from the commodity sides as well as from the FX side. So he knows about operations. Then next, we have Chris. Chris has many hats: entrepreneur, teacher, interim manager, a solid track record in corporate treasury, and also is involved quite a bit in technology. So we expect a lot from him. And last but not least, Seth is here. He's the real entrepreneur here. He represents Bound and worked in various ventures and is now actively with Bound facilitating smart FX hedging strategies. But I think he will tell more about that later because I was learning a lot in our prep session. Before we really start, some practical aspects. There's a chat box, there's a Q&A. I will try to tackle as many questions as possible. Unanswered questions might be answered upon later after the session. The session will be recorded, so you can also see it again after the session. Kendra of Treasury Excel will distribute. So let's dive in. Jesper, starting with you. In the agenda, there's the maintaining control and FX management mentioned, and that's where I want to start. Our audience is corporate treasurers, is CFOs, companies of various sizes. Some of them have all the time for FX management, others don't. What, in your opinion, are the essential components to build your FX strategy?
Thank you for the kind introduction and for having me here today, which is a pleasure. In regards to the question about the components for FX risk management, then before jumping into a clear answer, then I would like to start a little bit different. I believe a lot of treasurers or employees in Treasury often have a feeling about everybody else do better when it comes to FX management. And that is driven by that we as human beings often tell the good stories and leave the bad ones out. Likewise, when people tell how good they do in stock trading, but leave out the stories about their losses. So when treasurers or employees in Treasury participate in conferences, network sessions, they never hear someone say that they do worse than them own, but always talking about all the good stuff, and then people think they're running a little bit behind. So I believe that the treasurer or the treasury team, they has to start figuring out where they want to be on the ladder from good to bad, or in another context from 100% manually or 100% automated, and based on the clarification. What is the gain or losses in respect to P&L impacts, but also in respect to the time spent. Often we also discuss that we need access to data, and it has to be updated real time, or at least several times per day. I believe that I as a treasurer, if I need access to all data and I want it real time before I actually can act on my risk, then I believe I always will be in a position where I never act because there will always be small pieces missing. It could be that a bank account is not reconciled. It could be a good receipt not invoiced, not matched with an invoice. So you end up having double counting numbers. So instead of focusing on real-time data on all your components, I would say focus on maybe 80%. So once again, the rule about 80-20 kicks in. And then make sure that at least your 80% is updated. And then for the remaining, use predictions, which could come in terms of manual injections, or you could use some kind of machine learning, depending where you're on the ladder. And when talking about machine learning, it could be random forest technique, but end of day, it come down to the access to your data. And then work with them. I would also say work with some open windows for your hedging, which can bring you in a position where you're in a positive way can utilize that you during the day have some short or long positions you actually can net out, making sure that it's not only the banks that earn on your hedging perspectives. Then you asked of the components for proper FX management, and the answer for start, again, you need to sit down and figure out what you actually want to achieve with the resources available. How big is the FX impact on your EBITDA? Companies with a high margin could consider less real-time hedging, and opposite, companies with low margin could have a higher focus on hedging. It could also be that you want to hedge something outside your balance sheet, but of course that comes with the challenges, accounting treatments to the associated to IFRS. Looking on the components on their own, then start focus on the balance sheet and which of the account items which have actually the greatest impact on the potential risk you have in your FX. Secondly, the focus on your hedging mechanism and tools for that, making sure that the price time spent goes hand in hand with the potential impacts. I actually once had a CEO who always said, "Let's try to build it in Excel, and then see where we have the challenges before jumping into buying system A or system B." And that we also, where I am used today, try to figure out what is the processes, making process maps, figuring out where's the actually impacts. But the answer is that people need to sit down and figure out where I want to be on the ladder.
And that connects really well what's also recently with Eurofinance, where people said there's so much technology, but you have to understand what the process is before you start automating it. Perhaps going to you, Chris, because perhaps from another angle you can add on what Jesper's saying, or give your vision on the best strategy and the most important aspects.
Yes, first of all, thanks, Pieter, for having me on this webinar.
Of course.
Always good to be here. I mean, it all depends on, you said, what's the best strategy? There is no best strategy, right? It all depends on the type of organization. How big is your FX exposure? Is it 5% of your turnover? Is it 70% of your turnover? How big is the impact on your balance sheet, as Jesper mentioned as well? And it seems like we come back to the same concept in a lot of webinars these days. It's all about the data. We can only talk about hedging strategies once we know that the data we have is correct. And Jesper mentioned this as well. Maybe you should look at 80% of your data, and maybe that's why you hedge only 80% instead of 100% because of uncertainty. Maybe your data is not clean enough. But I mean, intercompany flows are also very important. I used to work in a company where for every external invoice, there were 10 internal invoices.
Dreadful.
Because the project was routed around the globe, from factory,
Mm.
from tax hub to tax hub, and those you have to analyze as well, and then you have to look at, are there internal netting opportunities?
Mhm.
Yeah, I've seen quite a few companies that say we have a lot of FX exposure. This is the number of FX we do a year, but if you analyze it, they actually could have netted off a lot of these FX flows as well. So really
Mhm.
trying to understand and knowing what is the foreign exchange that's going through your company,
Mhm.
which currencies are involved, what's the magnitude and the frequency, because it can be big, but it can be just a few transactions, and
Mhm.
also how repetitive are these transactions? Are these
Mhm.
all one-offs, unannounced, or are these repetitive salary, energy payments, rent payments, or so forth?
Mm-hmm. Mm-hmm. Yeah, good stuff. And going to you, Seth, you are different from the other two panelists, not somebody with a long track record in corporate treasury or in treasury, and that kind of also creates or makes you kind of the person with the fresh set of eyes looking from an outside perspective here. And the treasury community tends to be a bit inward looking or focusing on what they already know. If you come as an outsider into this industry, what did you see in FX management from the past into the current situation? What meetings do you have? What type of issues do you see before we go into what possibilities there are in the future?
Yeah, yeah, like everyone else, thanks for having me on here today. And Peter, like you said, I very much come from a technology background, so my background is in software development and building software tools. And I worked for a number of years building software for large commodity and currency hedgers. So large companies that had large exposures, and processing all of their trades to understand what they were doing and how they were managing that. Is today's price good? Is it bad? Should I lock it in for a short period of time? Should I lock it in for a long period of time? Which financial product should I use? Those are tough. Those are tough decisions sometimes. And just doubling down on something that Jesper said, I think the main thing is I think for a lot of people is coming to this situation in terms of what they should do with their FX management, their risk management, and how complicated it can be. How many choices there are. Like Jesper said, I think most people that we talk to feel like everyone else is doing it better than them. Just like Jesper mentioned, they said, "Hey, we know we should be managing this better, and we think everyone else is probably doing a better job with this, but there's just so much." And I think that there are so many choices. Chris and Jesper just mentioned at least 7 or 8 things here. How big your flows are? Are they directional? Are they one-off? Are they repetitive? Are they bi-directional? Should you net? Are you both buying dollars at one time and selling dollars later on? So should you try to net those things? Try to minimizing trading costs. Should is the price good or bad? Making your forecasts. Then you get into structuring the actual transactions and the trades. These are you a high margin business? Does your FX risk sit inside your gross margin with a thin margin, or is it an operational expense? You might want to take a different approach to that because it's hitting you way down farther in your financial statements. All these things just raise questions, and I think that's probably the biggest challenge of the people that we talk to, and it's kind of scares people into inaction. Fear of overhedging. They for some reason people feel like and well, I guess I might understand why, but like the fear of hedging 110% of my exposure somehow feels so much worse than hedging 90. Either way, I'm 10% exposed, but it feels like because I overhedged, I did something wrong. If I would have underhedged, maybe I was just being conservative. Again, both those approaches are fine, but it somehow feels worse. So I think all of these things and these complexities and the different financial products can oftentimes scare people into inaction or too little action, because it's just I'm overwhelmed by what things we might do. Ultimately, at the end of the day, I'm scared of putting together a strategy and having it go against us.
Yeah.
And then I have to do that unless, and this is, I think, the core buy-in, unless the company really top to bottom believes in all the way up through management, really believes in managing risk out of the company's finances. And because what you don't want to have is a treasurer or something who puts a hedging strategy in place. It's done, and then in retrospect saying, hey, the market moved against us, these trades are out of the money, so now it looks like that was not a smart strategy. In reality, it might have been a very smart strategy, but just we can't predict markets.
No, the glass bulb that's in previous sessions very often, or the crystal ball. I think it's the crystal ball is mentioned, and that's not what we want to build upon. And you bring in a relevant topic, because your FX risk strategy, as any risk strategy, is connected to the rest of the business. And of course we are here in a treasury community. So going to you, Jesper, the involvement, the buy-in of the rest of the organization, the board members and the rest of the organization is for many treasurers a hard task. Getting everybody involved. Sometimes it helps to mention legendary disasters or any other approaches. Do you have any words of advice how to connect either with disasters or any other ways to get the buy-in from the CFO, CEO, and the rest?
Oh yeah, that's a good one. And now you try to place me under the bus. But who has not either been in one or heard about one?
Read
I
about
think-
one.
Yeah. I have a friend.
A friend I know had a very bad trade.
I think we all have heard about the FX manager or FX trader making trades in the wrong direction, and or maybe even worse, trades made on bad data. The first one is clearly a human mistake, which with access to different kind of tools you actually can find out there today. So that could be structured hedging tools, or as Seth also mentioned, you can make end-to-end processes, making sure that at least you don't do the fat fingers. But making trades on bad data, I believe that is even worse. And especially if you do not know it's bad data, and then it turns out that you see it in the upcoming P&L, but then of course it's too late. I think one of the challenges convincing CFOs, from my point of view, is that CFOs mainly are driven by historical data, and has been used to only look on historical data, and it's something it can be so historical data, of course, cannot be changed. And then the FX component in the P&L is often mentioned as being below the line. So if you discuss EBITDA or EBIT, then it's not even there, because FX in a lot of instances only impacts your earnings before tax. So if we discuss the impacts on FX at the P&L, it's most likely only in a negative way, because I can't remember that CFO or controller or the CEO has asked me if I had a gain on the P&L, but they are clearly at my desk when we have a loss.
Yeah, that's funny, because there used to be in the good old days, the people who were in Treasury already 15 or 20 years ago, there used to be Treasury as a profit center. And then at one stage people said, well, that's not the way to go. And then you see a lot of focus on cost and on operational aspects, and on of course avoiding a loss. But I'm before we go into the AI and the technology, because the audience is pushing for that, I see in the chat box, is we have to get the rest of the organization involved. And Chris, perhaps you also have some tips for that before we go into solutions.
Yeah, it's very important that you, and it comes back to my earlier point, you have to understand the organization. It's not that you just, when you join a new company, you look at the outstanding payables at that time and you just start hedging, you really have to understand the flows in the organization. And also you have to understand whether, in order to avoid FX risk, they just ask all their suppliers, and they only quote in one currency, and they only request all the suppliers to quote in one currency. Yeah, so if you're based in Europe and you're supplying large machineries from the US, but you ask them to quote in euros, and then you state that you have no FX risk. Actually, you do, because I can bet you that they have priced in this FX risk in that price, because you're just outsourcing it to your supplier in a way, and they probably didn't give you the best rates.
Nope.
Yeah, so there's loads of areas you really need to understand your company. I think what's the objective of the Treasury department as well. As you said, we're not really profit centers anymore. And then we used to go to a cost center. Now Treasury departments are much more a value add, which means we have to step outside of our office of the treasurer, really go into the business, look at AR, look at the supply chain, look at procurement, and see where can we help as well. To really make sure that when we are procuring, we're procuring in the right currency. And if we're talking big amounts, if you're buying power plants, for a couple of billion of dollars or euros, then that really needs to be the price that you agree to in the contract is very important. But of course, if you buy lots of small items, that doesn't really apply. It's really important to understand the flows throughout the company. And also, once you go in and you start talking to procurement, to sales about currencies, they normally don't realize it. Very often they go like, well, we're Euro companies, we're based in Euroland. This client wants us to invoice in pounds, we'll invoice in pounds. Who cares? As long as we sell, right? It doesn't matter. But of course, the invoice is payable after 90 days, and it's almost like you have to be like educating internal consultancy, raising the bar that everybody is aware of the potential effects of exchange rate changes within the organization. So a lot of talking and a lot of meetings. But I've also been in companies, you talk about what is the purpose of Treasury, but then you talk to a CFO. I had one company where I was the CFO, where I was the treasurer, and in one of my first meetings, the CFO asked me, so Chris, we always need euros. Should we buy them now or shall we wait a week?
Yeah. And you had to make
Yes.
it happen. Give the magic words. Yeah.
Well, it's the three things can happen. It can go up, it can go down, or it can stay flat. I don't have a crystal ball, so I don't really know. And he was disappointed that the treasurer couldn't tell him what an FX rate would do. I think they think we're wizards sometimes.
Well, Chris, related to that, I think it's something that we laugh about sometimes is that same, if we were a Euro reporting company and we sign a Euro contract, there is never a time where someone else would come to us and say, hey, how come we didn't collect 105% of the euros that we could have collected on this contract? We just got what the contract said. But somehow, if we're a Euro reporting company and we sign some customer contract in dollars, and let's say we hedged it out perfectly and it paid right on time and everything went through quickly, we reserved the exact amount of euros that we expected. But if the euro strengthened, we say, well, how come we didn't get that extra 5% boost from the US dollar? A same currency contract would never raise that question, but then there's somehow like that assumption that we shouldn't take losses and we should be able to win. And that you need buy into that kind of like how much risk does a company want to take up and down? And
there's something else. If you allow me, Pieter, I just see there's a question from Erna as well, which is in relation to this. Even though you hedge economically 100%, and I have to keep explaining this over and over again. If you hedge a cost 100%, you will still have an FX gain loss. because of the difference of accounting treatment for the invoice and the hedge. And I have to explain this over and over again. And even though we're economically hedged 100%, there will still be an FX gain loss. Yeah, so there is a lot of education, and you have to train your CFO, you have to train the people within the company to understand how accountancy works, how the FX market works, and that technically from an accounting point of view, you can never have zero FX gain loss.
No.
It's a fact of life.
Yeah. I want to stop this discussion, because it's super relevant and interesting. We can have many sessions about how treasury can be accepted as a relevant job task in your company. But this is also about FX. And I want to go to the story of Seth, because I did a post on LinkedIn today, and I said, well, I know about the brokers disrupting the market. I know companies like Cantox disrupting the market and have a new view. And then I thought, well, now I know them all. And then suddenly Bound came up, and then there's a whole new approach to that. So not allowing you to pitch hardcore here for a quarter of an hour, Seth, but what are your new ideas here? Because you surprised me a bit there in our prep session.
Yeah, and I'll try to make this not too salesy, but just be an explanation of our approach, because we do have a very particular approach on how we bring these things across, and essentially, and Pieter and Chris and Jesper probably heard me say this in our prep conversation, but really inspired. If people know who Jack Bogle is, the person who was credited with inventing and popularizing passive investing. So 50 or 60 years ago, he invented the index fund. So, 50 or 60 years ago, if you were a retail stock investor investing your money in the stock market, you had two choices. You had to, one, somehow formulate an opinion of where stocks were going to go. I think Apple's going to go up, so I'm going to buy some Apple stock. I think Amazon's going to go down, I'm going to short Amazon. So I somehow have to formulate that opinion, however I do that. Or I've got to pay someone else to formulate my opinion for me. So I hire a investment advisor, give them my money, and they pick the stocks, because I'm not an expert. And Bound's founding story essentially was we were building software for hedgers, and we came to the same approach. We saw really two different types of active hedgers, corporate hedgers. One was very much taking a market approach. They wanted to research the market, they wanted to research rates, they wanted to see where things are going, they wanted to make predictions, they had a point of view. So this is like a professional investor, and there's nothing wrong with that by any means. That's one group of category that we saw. The other group were people who did very standard operational things. So they just did the same things every day, based on what was happening in their business, and weren't trying to time things, didn't have an opinion. They just had agreed upon policy or process they were going to go through, and they did it. And what we came away with is we can automate hedging that looks like that. We can make that simpler and easier to operationalize. So fast forward 50 years on the retail investing side, now over half the global markets are run by passive investors, which means passive investment strategies. I just give some computer program my money, it breaks it up across an index fund or some ETF that I've invested in, and it follows that strategy, and it makes my life very easy. All I need to do is give it some money every month, and it will follow that strategy exactly. That's what Bound's thesis is. Come up with a long-term conservative approach to how you want to manage some risk, set a couple settings, and then hit go. And doesn't mean you don't have control over it, but that you're taking a long-term conservative approach, and really the execution is just automated. The strategy will follow, the algorithm will follow the rules that you've set every day and just do that for you. And so whether you want to, what percentage you want to risk or what strategy you want to do, we want to make it as easy for a corporate treasurer, because corporate treasurers today have to do, again, very similar to what those retail investors need to do. They need to somehow formulate an opinion. Is the euro going to go up or down? Or and read a report from their banker or something like that, or somehow try to just bear the risk. So we want to provide some option in the middle that's like investing in an ETF or an index fund. It's simple, it's straightforward. Is it perfect? Absolutely not. Do we predict markets? Absolutely not. But you can set an algorithm to do the operational things that you could do every day, and it will just run, and it will do the exact thing that you told it to do every day from now until forever. So that's the approach.
But the input it uses, is your forecasting. So you do have to know
Correct.
when, what kind of need you have in I don't know, payrolling, investment, other costs you have. So
Yep.
you
Yeah,
feed it with your prediction as to the cost you have in your company in what currencies.
correct. So you would pick, and you can pick a couple of different strategies. We essentially have 3 of these that you can say, hey, for this exposure that I have, here's my forecast and here's the approach I want to take with it. Go for this other exposure, this is the strategy I want to take with it. Here's my forecast. And yes, that's how you use the bound application, is you feed it your forecasts. It's okay if
Yeah.
they're wrong, if they're up or down, we adjust the algorithms. You thought it was going to be 2 million in January, it's only going to be 1.8. No big deal, just adjust the number. But that's what you do, is you feed bound your forecast.
Yeah. Are your clients able to forecast? Do you meet companies that have that process under control?
Yeah, so we do, of course, have customers who have that under control, but and that's not an area that Bound does a lot to help with today. There's lots of other forecasting tools and tools out there to help you do that. Once you have your forecast, you can feed them to Bound, but of course we have a variety. Some things, like if you have a payroll, you have an office in a country with like high costs and very little revenue, you have a pretty predictable payroll cost in that currency. That's pretty easy to forecast. If you are a travel company, it might be very hard to forecast what travel is going to be booked today, next week, next month, which location is going to be a hotspot this season. Those might be much harder to forecast.
And listening to this, Jesper, and you know the various strategies, of course, hedging spots of our forward derivatives, or any other. Use it in find your risk mitigation in your value chain. If you listen to this, what's your first response? What do you think?
I think it could be good to utilize different kind of approaches, but I think it's important also for the audience that they sit back and figure out where they want to be on the ladder we initially talked about, because as Seth said, if so the entire setup or some of the setup is based on the forecasting, and so internally you need to start with your forecasting. Can you forecast, and how much do you actually want to forecast? But I like the idea that we get more and more opportunities and different kind of tools assisting us in end-to-end processes, but we also need to make sure that we used to say garbage in, garbage out. So it all starts with your data, and do you want your data to be 80%, as we talked about, or should it be 100%? So that is where the root cause, of course, will be, and where people need to start.
Yeah, and Chris, if you listen to the input of Seth, there are various strategies. I mentioned them. There are various companies types you worked in. Would you consider one tool is the best strategy, or is it also possible to fill your toolkit and make kind of a blend of all kinds of tooling you use to make the optimum, or would that be too much of a hassle? You're muted.
There you are. It depends how complex the FX flows are in the business, but most of the time you don't just have one type of flow, right? You have your accounts payable, accounts receivable. Those might be quite regular, more or less the same amounts. For that, a solution that Seth explained of bounds could work very well. There's of course a lot of FX hedging, or more of the larger numbers, maybe the intercompany loan hedging, which is a swap, for example. It's more of a one-on-one, and it also depends on the amount. Although a trade automation is fantastic. I mean, even trading through online platform 360T, FXO, Bloomberg Go, which is just like an aggregator to connect to your financial counterparties. That's also very nice. They can even automate some of that. But if you want to do a trade to buy $250 million, that is a big one. You would still call your trader. And I think the same applies here. Yeah, if it is really large volumes, if it's repetitive, a solution that Seth mentioned would probably still work. But all the big ones, probably not. And see, the more sophisticated you are, if you have a treasury system and you understand how options work, yeah, and you want to have more flexibility, yeah, in what rate you are willing to accept or what loss you are willing to accept. But especially the small size, medium sized companies, maybe one treasury person might not have a treasury system. You don't really have the tools for this.
Nope.
Yeah, and then these automated trading solutions could be a perfect way out.
Yeah, and that connects also to you, Seth. What do your clients blend tooling, and what kind of clients do you serve preferably? Where do you shine?
Yeah, we and to answer Chris's question, you're right. Essentially, if you have treasury expertise in your team that is so professional, they're really professional traders. Then tools like Bound may be helpful or may not. If it can help simplify their life, great. But fundamentally, if they're essentially a professional trader, I use this, Pieter, when we spoke before. Like, I have a lot of friends who work at hedge funds, having lived and worked in New York City for a long time. And generally speaking, as a general rule, they don't invest with index funds. Fundamentally, they view themselves as professional traders. They study the market. They have a view on the market.
Yeah.
So if that's the case, then Bound's not the best tool. Bound's a tool more for people who say, hey, we don't want to invest the time to develop skills to become professional currency traders. We want to invest our time other places. Is there something quick and easy that makes best practice simple? And that's the group that we target. And those are mid-market businesses as a general rule. People who have enough FX volume that this is material, but don't want to have full-time staff or staff spending huge amounts of time formulating opinions on where markets may go. So that's and then the other thing, Chris, to mention kind of what you said, the other thing that we think is important is, trying to get that managerial buy-in. For example, one simple strategy that we use that's quite popular is we just break large transactions into very tiny little pieces and execute them over a long period of time. 3 months, 6 months, trailing average exchange rate. That we have found has been easier for many treasurers to get buy-in from management, saying, hey, listen, is the market going to go up or down? I don't know. But if we want to transact on the 6-month trailing average rate, that's a pretty conservative view, and I never really need to pull the trigger and have a point of view that any one rate is good or bad. And that is something that then it's easy to get sign off on that policy, saying as a policy, that's how we'll manage that risk, because that makes sense to even the board members. And then when there is a gain or loss, there's not a question of, did the treasurer click the button at the right time? It was, hey, we decided as a team, we were going to transact on the 6-month trailing average.
Yep.
Sure, at any one given time, the spot rate might be better or worse, but we took a smart long-term view. We didn't we didn't take a view at 115 as the rate. We took a view of a long trailing average. Example.
Okay, we are nearing the end, and I want to blend in two questions into one for the whole group of panelists. And perhaps there's also 3 options you can choose from. Either you look at the webinar chat and you see something you want to answer on, or there's some practicalities, some really low-hanging fruit in FX management you want to mention because it should be mentioned here. And last, also very interesting is what's your vision on the future when it comes to FX and automation? I'm very curious about that because at Eurofinance there's a lot of talk. I think we all need to have an understanding of what's happening under the hood, but there's a lot of new technology coming up and new solution coming up. So I give each of you first Jesper, then Chris, and then finally Seth a moment to give some final 2 or 3 minutes and share some thoughts. So Jesper, you first.
Yeah, thank you. It's funny you mentioned that we on Eurofinance and also in other conferences, the buzzword at the moment is automation. So going back in time, we had a lot of conferences with different kind of buzzwords. People most likely also recall we had eBay and we had virtual bank accounts. So it could be funny to see where are we actually today, and do we believe that now we talk about automation, will we actually put a lot of automation into our workflows down the line if we take the approach that we talked about, eBay, virtual bank accounts, etc., some years ago, and where are we today with that? Of course, I believe that all people would like more automation, using less time on putting in numbers, more time on analyzing data, and the CFO most likely will say, okay, if we can automate, we most likely can scale down on the FTEs, and we can leave some costs out. But again, what is it you want to automate? Is it an end-to-end flow? Is it your data structure? Is it the hedging approach? So I think that will be the main questions for the audience. Then there was a question whether or not you can use FX options for your balance sheet hedging. Of course, you can do that, but it also put on a lot more complexity on both your own side. What is it? How do you want to structure that hedge? Do you want to be out of the money, at the money, in the money? Do you want to take a huge cost up front and then have a possibility to gain a lot? And then also, do you actually have people in your accounting department that actually know how you need to account for this, and not only you need to put in your trade, either the put or the call, but what happened tomorrow when the market have moved? How do you structure your delta hedging? So I think. Of course, you can use FX options, but and it can give you some flexibility around how you hedge and what you want to hedge, but it also comes with complexity. So, and then my last thing was what we not have discussed today is that who are your main stakeholders in your company? I believe you need. If you want to automate and you want to utilize the automation, then everything again comes back to data. So your accounting department or your controlling department will be a very important stakeholder for you, making sure that everything is updated. Otherwise, it's again garbage in, garbage out. Now just in an automated way.
Chris.
Thanks. Yeah, and I think Jesper says a lot of right things there. And once again, it's the data, and we all like to automate things. I think if we all could make our life easier, that's very good. And AI could do a great thing because they could do everything for us, and it will be great. But AI needs to only comes to a decision based on the input. So you have to get your own data in. Then you have to make sure, if you believe that AI can give you a view on where euro dollar is going, where does AI get their input from? Yeah, if it browses the internet, I don't know where it will get its input from and whether that's trustworthy. Maybe I can link it up to Bloomberg, and you can scan all the reports on Bloomberg, and then you can come up with a vision and a proposal. That would be very nice, and that would actually be useful. And then the treasurer can actually take the final decision, because it will go by step. I think no treasury will automate robot executions of their hedging program. They would, without, and then it has to stay within your hedging policy as well. What can happen is you have your treasury system, you upload your treasury policy with what am I allowed to do from the boards, what is my current treasury exposure, what can I do? And very often these treasury policies are very strict anyway, so there's not much room that you can do, and that's probably where the automation will go. The treasury system or the AI tool will provide you with your recommended trades.
Yeah. So summarizing things here, Peter, you asked two questions. One is if the one kind of recommendation or a thing to think about, that would be not to get frozen into inaction on known risks. If you're 0% hedged, then you're 100% exposed. If you're hedged to your best estimation, you're 20% wrong, then you're 20% exposed, and try to eliminate that as soon as you can. But frozen into inaction often means exposures get left wide open. So that's one thing you don't want to be. You don't want to be 100% wrong on what your forecast is. And then kind of doubling down on something that Chris said with the slight variation in terms of where markets are going and how technology is going into the future. I think AI can help a lot with making predictions of your needs, helping you with your forecasts, helping you stay in line with your policies. But I would, as a core, and this is a core belief of Bound, AI will not predict markets. If you think you can drop your the euro-dollar history into ChatGPT, and you think that's going to outperform Bridgewater and the largest hedge funds in the world that have huge amounts of money to train their own models, like you on ChatGPT is not going to. I wouldn't rely on AI to outperform any markets, because there's someone else investing 100 times more money into their AI model to try to outperform markets, and that's just not a game you want to get in. So AI is great for some things, but in terms of we have a firm belief here at Bound that AI is not going to predict the future of markets, and believing that is dangerous. Yeah,
do agree. Thank you very much. Well, great stuff. I must admit, there's quite a bit of notes with me where I really have to digest. I'm pretty sure that both in my notes, but also in the notes of the people in listening to you, there's a lot of good they can use in their daily operations, as well as in their future strategy. So thank you, Chris. Thank you, Jesper. Thank you, Seth, and thank you, of course, people of Bound and Treasury Excel. So, and of course thank you, audience. Great you were here. Hope to see you in the next webinar, and keep tracking us through socials and our website. Have a good time. Bye.
Thank you.